post-COVID, if you did analysis of the large IT/ITES companies, about 65% of their talent went back to these 8 odd cities where we are already present. And we believe that many of those cities have great infrastructure, great lifestyle opportunities, and many people will probably end up staying back in those cities. And we are seeing some very, very strong demand across those cities. We also strongly believe that the demand ecosystem is going to be similar. A large portion of it is going to come from IT/ITES or large corporates, and a subset will come from banking, finance, consulting, construction, many of those cities. And clearly in FY24, 14% of our cities of our seats were launched in tier 2 cities. So we are a strong believer. We have the largest presence in tier 2 cities across the industry today, and we believe that the growth journey will continue across the 9 metro cities where we have almost 90% of our seats, and tier 2 cities where we are expanding fairly quickly.
So 15% is what I heard, right? That's the number we should work with going forward as well?
Broadly, yes, Mohit. So today the portfolio split is 90-10. But if you look at Q4 of FY24, about 14% happened in tier 2 cities. So that will move closer across the years to a 85-15 split.
Okay, understood. Thanks a lot, Amit. Those were my questions. If I have more, I'll join back the queue, but best wishes to your team for future quarters.
Thank you, Mohit.
Thank you. The next question is from the line of Viral Shah from Enam Holdings. Please go ahead.
Yeah, thank you for the opportunity and congratulations on a successful listing. I had a couple of questions. Firstly, just to clarify, Ravi did allude to this point earlier in his about the cash EBITDA. I think he was trying to state that FY24 cash EBITDA is actually closer to 90 odd crores. Can you just help us explain this part again, just because it was not fully clear?
Yeah, hi. Thank you, Viral. So cash EBIT number for FY24 is 97 crores to be precise. And the way we calculate the cash EBIT is EBITDA less the actual lease payments. And the reason for doing this is because, as you are aware, that under Ind AS, the lease payments are below the EBITDA line. So what we do is essentially we subtract the actual lease payments from the EBITDA to arrive at the cash EBIT for us. So that's how this number is 97 crores, which is a growth of 168% year-on-year basis and was 36 crores last year.
Okay, sorry, this is cash EBIT or cash EBITDA?
It's cash EBIT. EBIT.
Okay.
Yeah.
Okay. The secondly was I just want to understand your strategy. It seems that you are more focused on the smaller cohorts, both on the demand as well as the supply side. Now, if I look at this seems to be at a variance with your competitors. Can you just help us understand what is the rationale behind this?
Sumit, you want to take this?
Yes. So, Viral, it's the point around the overall fundamental business model. So, let me give you a perspective from the demand side. The best way is to take an analogy of retail banking versus NBFC. Now, the advantage of a retail banking is a diversified portfolio of clients with, a lower risk. While it takes longer to build and it's more hard to build, but it's more sustainable from a long-term perspective. So we have followed a similar, approach by creating a larger number of centers so that we can attract a larger segment of users. So be it SME, mid-corporates, larger enterprises. There could be a situation where a small cohort of 25 seats could be taken by a larger enterprise as a starting point of relationship with office. But that same enterprise is taking almost about 300 or 400 seats with us in some other center after experiences those 25 seats with us. Secondly, what we have seen is a smaller cohort ends up getting a better pricing realization as compared to a larger cohort. That's why we love the aspect of catering to smaller cohort. Third, it makes churn more manageable and less risk averse. So what we see is typical center sizes of about 600 to 700 seats usually ends up having 20 to 25 different clients across various kind of codes. So across years, as the companies keep moving out, so it's very easy for us to manage the churn and create a more sustainable and risk-averse kind of a business model. It's a tough capability to build because it requires very strong operations processes, and we're proud that we are one of the only players to deliver this capability on at a scale. And I think it's a moat and a tough one for a lot of players to replicate. So that's the primary aspect on the demand side, why we look at smaller cohorts. With respect to the supply side, as you would see, our center sizes are generally about 30 or 1,000 square feet, with a lot of players looking at large centers. The same logic and on the business model, we have a perspective in the size. A mid-sized center brings decent level of operating efficiencies in terms of the total operating cost, so there is no kind of loss of operating efficiency. But it's a very risk-averse scenario. We are able to build the occupancy in a span of about 7 to 9 months to about 80% of the occupancy. So it's easier to build the occupancy. Second, it's easier to manage the churn. Third, one can have a very strong kind of a larger network. So that's the reason why we have now 181 centers across 17 cities. An interesting aspect over here is if you have a larger network, the network effect from customers also come in. As you would see, almost 30% plus of our customers have taken seats with us in more than one center. So that's how a larger network with mid-sized centers as a strategy has worked out well. And our endeavor is to continue with this kind of a business model.
Perfect. Thank you, Sumit. That's all from me.
Thank you. The next question is from the line of Adhidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, good morning. Thank you for the opportunity. So first question is on your margin trajectory for FY25. So you related that you're expecting a 150 bit sort of expansion next year. So could you help us understand in Q4 what has been the exit run rate for the month of March, right? Which should give us some directional headroom. And for this margin expansion, what are the levers for this expansion to come in gradually? Yeah, that's the first question.
So, thank you, Adhidev. So for Q4, our, the EBITDA exit margin is at around 11.7. The levers for the improvement in margin, the 150 bits point what you're talking about, will largely come from the operating efficiencies and the operating leverage. So as we expand our network, we expect, efficiencies to come in further.
Okay. So if you are already at 11.7% in Q4, right? So for the full year 25, shouldn't this number be a little higher at 12% plus? It's looking at more operational efficiencies coming in as the new seats come into operation.
So we are also expanding very rapidly into new, as Amit mentioned, in a few of the new cities, and also, we're expanding in some of the new centers in the existing cities. So there will be also an impact of, new centers and the cost-related costs coming in. So what we are expecting is that, at some point of time, it will balance out with the improvement in the operating margins, and hence 1.5 is what we are taking as an improvement in the operating margin.
Okay, for the full year. Okay. Sir, then the second question, so just following on that, so then what would, on absolute terms, in the month of March, what would be the EBITDA run rate we'll be doing monthly as we have exited March 24 on a monthly basis? If you could share that number.
So then that number would be around 9.5 CR.
9.5 CR. Okay.
Again,
Fine.
Adjusted for all the lease, India's, 116, 102, 109 accounted for. Adjusted.
So this is the IGAP EBITDA
equivalent to an IGAP kind of a scenario.
Okay, around 9.5 crores for the month of March. Okay. So, and the second question is for the full year in 24, in your expenses, either on IGAP India, are there any one-off expenses or gains which are part of the EBITDA? If you could just clarify that, please.
So, there are no one-offs in the real sense. However, we had this, couple of, legal costs related to the selective capital reduction, what we did. So, and the fundraise, what we did. So, there are one-offs pertaining to that. The fundraises and the selective capital reduction process, what we went through.
Okay. And so final question is, obviously pre-IPO as of March 24, what is our net debt on books? Because there seems to be, as per the reported cash and cash equivalents, do not seem to reflect the total cash on books. So you just help us understand the net debt as of March 24.
Net debt would, so we are carrying around, so the net debt would be around minus 25 net of cash. So 32 is the gross sum, and the net debt is around minus 25 as of March.
32 gross. Okay. Fine. Yeah. No, fine. That's clear. I'll come back in the queue if I have more questions. Thank you.
Sure. Thank you.
Thank you. The next question is from the line of Bhavik Dave from Nippon India Mutual Fund. Please go ahead.
Yeah, hi. Good morning, sir. A couple of questions, sir. One is on pricing. So just wanted to understand when we are adding incremental seats, depending on the location, right? Like maybe the top 10, 15 locations versus the tier 2 locations. How has the pricing moved incrementally in fourth quarter, and how do you expect that to move in for FY25, like-to-like basis?
Sumit, you want to take this?
Yeah. So, Bhavik, our pricing is a direct function of the input real estate cost. The way our financial models are built is we look at two parameters very strongly. One is the overall center EBITDA margin, which could come around. And second is the payback period. This is the kind of capital which we are investing. So these are the two primary, drivers which is driving the pricing. So within the same micro market, two buildings could have a different rental, and that's why we would have a different kind of pricing realization. So as you would see, we already have a diversified kind of portfolio on supply side with micro markets like BKC and CBD in Bangalore with higher rentals to micro markets in Calcutta which have very low rentals. So our pricing of the product on a per seat basis ranges from about 6,000 to 18,000 rupees per seat per month. We expect that we will follow a similar kind of rule and the financial metrics to determine the pricing. In any case, the way we look at as we grow into tier 2 cities, we don't see that the blended average realizations will go down because the micro market rentals of tier 2 cities are also equivalent to the micro market rentals of the peripheral places of the larger towns. So let's take an example. Let's say if we end up being in a micro market in Jaipur, the micro market rental could be also similar to the micro market rental of Navi Mumbai. So our pricing would follow the blended pricing of the whole portfolio will follow the similar trend, but we focus more on the keeping the center EBITDA margins and payback periods intact.
Sure. Just to make this simplified, when we look at FY25 over 24, on a blended basis, you made a point that incrementally 15% of the seat addition or the outstanding would be tier 2 cities versus 10% today. So like to like, if we have to compare FY25 over 24, the blended realizations, all else equal, will be like 0 to 5% higher than what they stand today, right? Like considering all the escalations and the new additions and the mix shift, everything included, the number should be 0 to 5% higher than what it is in FY24 overall blended, right? Is that a fair assumption?
So with respect to an existing center, as customer, so on a client contract, we already have, escalations being built in. Generally for a larger cohort, these escalations range from about 4 to 6%. And for a smaller cohort, it ranges from about 5 to 8%. So yes, from a existing center portfolio perspective, there is going to be a, like-to-like increase in the overall pricing.
Understood. Second point is, Sumit, when we look at our mix today on revenues, which you highlighted 75-76% is the co-working space, and the remaining 24-25% is the transform business or the build and fit-out business. Do you expect this mix to remain broadly in this range, or you think that can have that can change over the next couple of years? Like if we look at 2-year horizon, will the mix of business revenue remain similar, or will it change?
So, from our standpoint, we offer this as a complete comprehensive solution, right? So as I mentioned in my opening remarks, that this is a, overall blended, we are a solutions platform. So clients come to us for co-working, for, doing customized solution for them, as well as for design and build, which is our office transform business. So it's an integrated offering. Now, what we feel strongly is that we'll continue to have about 75% of our business in co-working and about similar about 20-25% in design and build. So this will continue, but we will continue to offer the comprehensive solution so client can choose us for either taking co-working seats with us, managed office solutions, or if they take up their own space, then we can deliver a design and build solution to them.
Sure. And the transform business EBITDA margins, are we optimized, or you think there is some bit of improvement there as well? And what would that range be in today, and if it can improve, how much more can it go up to?
So currently, this is about 14 to 15%, right? As you can see from our financials. We believe that as we continue with our scale, as we mentioned, we are doing 40,000 seats in our expansion for this year. In addition, obviously, this does not include the design and build business, which effectively will also translate to seats. So our buying power in the marketplace is very, very high, right? So we believe through our procurement strategy, through our efficiencies in terms of our delivery, in terms of our solutions, we will probably be able to get another 1.5% to this 14 to 15% margin for FY25.
Sure. Just one last point of suggestion that I would request is if you can give a very clear last 2-3 year pre-Ind AS P&L balance sheet cash flow, because it's very difficult to reduce the adjustment that we're trying to make because for last 2-3 years, if you can provide that kind of data every quarter from here on, will be very important, because you yourself are looking at the business on a pre-Ind AS basis, and from an investor perspective also, that will be very helpful if you can simplify the way we report our P&L balance sheet on a pre-Ind AS basis. That's a request. Thank you.
Sure.
Thank you. The next question is from the line of Arpit Shah from Stallion Asset. Please go ahead.
Yeah, congratulations on a super listing. I have a couple of questions. I just list down all my questions. Just wanted to understand the square feet breakup or the per seat kind of breakup for CapEx in MA as well as in SL. That is my number one question. Just wanted to understand the 30 crores cash EBIT number which you've reported in Q4 FY24. Would you say this is a steady state number for the quarter, or do you think there is some operating leverage which is going to play out in FY25 and FY26? And what would be the tax number for the quarter if you have to include that? And I just want to understand what would be ESOP expenses for FY25 and FY26, since you have just listed now and we do have some ESOP pool. And I believe there was some 50 crore kind of a payout to Mr. Ramani on the IPO listing. And just want to understand how are we going to account for that number? What would be our corporate overheads on an annualized basis? Just wanted to understand that.
I'll answer the last question that you had, and then I'll request Sumit to discuss the MA and SL split. So the number was not 50 crores, it was 5 crores to clarify. And as per the current, committee, I have completely foregone that number.
Okay.
So over to you, Sumit, on the CapEx part on MA versus SL.
So, Advait, with respect to the total CapEx which we spend on centers, we end up spending about 1,700 to 1,800 rupees per square feet on the center CapEx. So, irrespective of that center being under managed aggregation or straight lease model, The difference generally in CapEx varies from a bit site to site on the site condition. So that's the kind of, only, 5 or 8% kind of variability across various kind of, sites where the whole CapEx would vary. Then, so that's the overall CapEx spent per square feet. Second, your question is around on the cash EBITDA basis. Can you just repeat that question on cash EBITDA?
Yeah. So we have reported on 30 crores cash EBITDA in Q4 FY24. So is this a steady state number, or we've already guided for 1.5% margin expansion? So that I think so includes a lot of operating leverage. So this 30 crores is a steady state number, or you should see more? Is there a downside to this number, or this is a steady state number going ahead?
So, see, going ahead, the absolute basis of, the cash EBIT will also change with the, change in revenue. And for the full year, you will see a 1.5% improvement in the margins. That could be, distributed across multiple quarters. As we are giving more on an annual guidance, I'll not be able to, exactly give you a perspective whether Q1, what is, how much improvement is going to come around. But on a blended for a full year basis, we will have a 1.5% improvement.
Got it. And what would be the ESOP expenses for FY25-26?
Okay.
So the current unamortized pool for ESOP expenses is around 6 CR between FY25 and 26.
Okay. And the corporate overheads?
So corporate overheads, let me split that into, so essentially the corporate overheads, is comprising of the employee expenses. Now, within the employee expenses, we have two ways of, accounting for that. So the employee expenses which are at the centers what we have, that is as part of the, the MA structure deal, that is part of the center EBITDA margins. So that is not in corporate, in the real sense, that's not a corporate overhead for us. The corporate overhead for that is because that the cost of that gets distributed between the landlord and us. On the other corporate overhead, which is the salary for the HO staff, is around in the range of 5 to 6%.
5 to 6% of total revenues, right?
Total revenues.
Yeah. Okay, and the 30% revenue growth that you have guided is on total revenues, or is it on co-working business segment?
It is on total revenue.
Okay. Thank you so much.
Thank you. The next question is from the line of Bijal Shah from RTL Investments. Please go ahead.
Yeah, hi. Thank you for the opportunity and congratulations on listing and building a very solid business over a period of time. My question relates to competition in the segment. Now, every day in newspaper we read that there are multiple companies in the space and they are raising money also. In fact, 3 to 4 IPOs are also lined up. So how do you see competition? And in fact, in your industry report also, there are like 80 players operating in city like Bangalore and I didn't see anywhere more less than 20 players operating. So from a competitive perspective, do you see that there could be a demand-supply mismatch and which can impact pricing or occupancy over next 2-3 years?
So as kind of we mentioned in our opening remark, the industry is fast growing, right? By 2026, it's projected to be almost 16% of total commercial real estate, equaling to almost 105 odd million square feet. So I think it's a sunrise sector, and I think healthy competition across the country helps provide the right solution for the customer. I think just as in real estate, there are multiple developers who coexist and do well. I think in our industry also, competitors will all coexist and do well. As far as we go, I think we clearly have differentiated ourselves, obviously being the largest when it comes to our network, 181 centers, and projection is to grow by almost 40 plus centers in FY25. The platform approach, which we believe is very unique, which is the ability to offer somebody 1 seat to 1,000 seats. We can now design, we can build, we can maintain, we can operate, we can do all of that under one umbrella. So all commercial real estate requirements are fulfilled. Our differentiated supply model, I think we strongly believe that by having capital efficient model in our managed aggregation structure and diversifying our risk by partnering with the landlord completely differentiates us from everybody, and we have a very, very different scale. Almost 120 odd centers out of 180 are in managed aggregation today. The size of centers matters. Sumit talked about the centers, typically about 30,000 square feet. As a result, we can have multiple locations across a city in cities like Mumbai and Bangalore. Today, we have close to about 20 plus centers in each of these cities. So kind of the size of the center matters, and obviously reduces our pre-operative burn, reduces the concentration risk. We cater to all kinds of customers, right? A large portion of India's demand is less than 100 seats. And we probably are one of the only branded players left in that space catering to that customer base. And even less than 100 seats, which is almost 50% of our demand today, it's split equally between 1 to 25, 25 to 50, and 50 to 100. So clearly we cater to SMEs, mid-corporates, large corporates, startups, freelancers, every type of customer segment in this country. And clearly when it comes to tier 2 cities, we strongly believed in it and went into expansion in those cities. Today, we strongly believe that the tier 2 strategy is a big differentiator for us and our ability to offer, kind of solutions for our customers. So I think competition is great and is healthy. We welcome all other people to come to the public markets. But we currently believe that we are extremely differentiated business, and we believe that that's the reason that we obviously will continue to grow while, mitigating, the competitive landscape.
Yeah. So just to understand, like overall at industry level, you do not see much risk of oversupply. So demand is really that strong that it can accommodate growth plans of most of the players who are there. And in fact, all of them are looking at a significant increase in their seat capacity. So you think that demand is strong enough to accommodate all the players?
Yes. See, primarily, if you look at the way we are generating demand, it's a primary shift of people choosing conventional offices to moving to flex spaces. The total amount of leasing which happens every year is anyways increasing, and the percentage of flex space leasing is growing. So we are having a share because the customer preference is moving from conventional to flex spaces. So that's why there is a very large demand which couple of players are catering to. Because the business doesn't have much entry barriers as it looks like to begin with, be it like, even from a hospitality play, if you look at an example of hotels, there are a lot of branded players. There are a couple of branded players, but a lot of players in the thing. But ultimately, the larger market share is taken by the branded players. This is exactly what is happening in our industry, that the top 5 or 6 players are having a larger market share and they're growing with the network effect of the customers. So we don't, worry around on a large number of co-working players opening up in every city. Our customer base is increasing and the customer base preference is shifting from conventional office to flex office.
Okay, got it. And sir, right now, as you explained that there is impact of newer properties on margins, but eventually, say probably 2-3 years down the line, when the proportion of new property really reduces to a small number, what kind of steady state margin we can look at?
See, while we are not giving a guidance right now for the overall steady state, margins over the next couple of years, but you are right. Once, after at least for the next couple of years, we see a strong growth for the whole thing. As the percentage of existing centers versus new centers reduces, you will see a natural increase in our overall margin profile, is what I can say right now.
Okay. Sir, lastly, one request. See, it seems that the data which is available as per Ind AS is significantly different from the way you yourself analyze the business. So it would really help if you can split the employee cost into center, and if you can give center level profitability for the quarter and then give us the corporate overheads and also spell out exact number of rent amount and adjustment. It will really help, not only for the quarter, but probably for 2-3 years, so we can actually see the trend as somebody also pointed out. So that would really help all the investor in better understanding a new company which is from new sector. Thanks a lot.
Sure.
Thank you. The next question is from the line of Kunal Sharma from SP Capital. Please go ahead.
Yeah. Thanks for the opportunity and